Good afternoon, everyone, and welcome to another Nadex webinar. This one is Technical Analysis, the Basics. We do a series of these webinars to welcome people to Nadex, welcome them to our markets. So I want to welcome all of you for joining, and thank you for joining. We have got thousands of new traders in our markets over the last 6 months. It's been absolutely incredible. Love having everyone here, and we want to offer some help and assistance, particularly for those newer traders. We get a lot of those folks here at Nadex who are looking to dip their toe into the markets, and there's a reason why people come to Nadex for that, and I'll get into that in a moment. But in this session, I want to go through the basics of technical analysis and give you a foundation on so that you can start doing it yourself. I mean, in the end, that's the whole goal, is help people along the way so that they can do it themselves. Before I begin the presentation, I do need to share the disclaimer. This webinar is sponsored by the Nadex Compliance Department, and I do need to share that trading involves risk and may not be appropriate for everyone. That any trading decisions you make are solely your responsibility and at your own risk. And this is an educational session. Please do not construe anything I say as a buy or sell recommendation. We are doing this for your educational purposes, and that'll become a little bit more clear because part of this presentation, I will be doing a practical demonstration of technical analysis on some charts, and I don't want you to take that as a buy or sell recommendation. We're just going to be showing you how to use some of the tools. Now, what is our agenda today? What are we going to cover? Because we've got so many new folks here, I am going to cover briefly who is Nadex. I'm not going to spend a lot of time on that because I want to get into it. I really want to talk about first, where does technical analysis come from? I find a little bit of a history lesson is actually kind of interesting to understand where it came from, and I think it's interesting. I won't spend a whole ton of time on that either, but it is always kind of fun. But the foundation for where it came from and what the concept is will help you become a little bit more familiar with why do you even care? I mean, what does this do for you? And understanding where it came from helps you to understand why traders find value in technical analysis. Then we're going to talk about some real basics. I mean, again, we've got so many new customers. We're going to talk about a candlestick chart. We're going to talk about candlesticks, a candlestick chart. We're going to look at a few different technical analysis patterns, some basic ones. We're going to talk about trends. We're going to talk about reversals. We're going to talk about support and resistance. If these are all terms that are unfamiliar to you at the moment, or you're not wholly sure what they all mean or how they work, we're going to go through that. We're definitely going to go through that. And then I'm going to talk about some of the indicators and drawing tools that Nadex has available. We have them baked in and built into our charts. And as I mentioned, once I do that, I am then going to go over to the platform and show you. I am going to show you. So that's what our agenda is for today. Before I jump over there, I do want to mention that this is an interactive session. All right, so first of all, I should have asked this earlier. If you've got a little questions panel in there, if you could just tell me that you're hearing me fine, that would be great. I know that there's some people that have technical issues, they can't hear me. I just like to know that I'm coming through loud and clear. I would imagine at this point someone would have said, I can't hear you. Usually it's a browser issue. So perfect. Thank you everyone for that. I am going to point out that this is interactive. You just found the question panel. If you've got questions as we go, type them in. I will be monitoring that and I will try to answer them as we go. But if I don't answer them right away, I will try to look back at them at the end and answer them so that I can get anyone's questions answered. But if for some reason I don't get to your question or answer it wholly, or you've got a question later, you can email customerservice@nadex.com and ask them. You got any questions about our contracts, our products, our markets, the platform, your account, you can get help. We are here to help. The other thing I'm going to mention right up front is I am recording this session. The recording will be available both on our YouTube channel as well as on our website. You go to learning webinars and in the archive, I would recommend that you check out our YouTube channel, maybe even subscribe to it every morning, 8:45 a.m. Eastern. We stream live and do a morning analysis session. We stream it live on YouTube. You can watch it live. It immediately posts the recording. So if you're a little bit late, 8:45 a.m. Eastern, roughly till 9 a.m. Eastern, about 15, maybe 20 minutes tops. And we look at hotspots in the market and we do some technical analysis on the markets and take a look. So if you'd like to participate in those, go back and check them out. You can go back and listen to the one from this morning if you'd like. That's all on our YouTube channel. You just go to YouTube, look up Nadex, and you'll find it on our past live streams or in our videos. I'm sure you'll be able to locate it. It's the morning analysis, Nadex morning analysis. Okay, enough with that. Oh, you know what? One more thing I'd like to mention, because I am recording the session. If you would like a copy of this slide deck, email customer service at Nadex and you can request it. I will make sure they get a copy of the slide deck when I'm right after this session, and they will be able to send it to you. So not only am I recording it, I'll make this slide deck available to you. So if you'd like to play this back, you'll be able to and actually have the slide deck in front of you. All right, let's quickly cover who is Nadex. Because we have so many new people in our markets, so many new traders, I like to quickly go through who is Nadex. And it's actually important when we talk about technical analysis in our markets to understand what Nadex provides. One, Nadex is an acronym, as a lot of the financial services industry loves acronyms. It is an acronym for North American Derivatives Exchange. And we are a regulated electronic exchange. Now, we are regulated by the CFTC, another one of those acronyms, the Commodity Futures Trade Commission, the Commodity Futures Trading Commission. Now, why is that important? I'm not going to worry about the designations that we got, but the reason it's important is a lot of people come to Nadex to trade binary options. And I can tell you that there are a lot of binary option providers in the world. In the United States, there are actually only 3 exchanges that have a medallion from the CFTC and are regulated. I don't think one of them is trading at all yet. One of them, it does weather contracts and it doesn't trade very much. So Nadex is the premier binary options exchange in the United States. And that is important because we are regulated and we have to adhere to all laws, rules, regulations of the United States. We are audited and monitored and regulated by the CFTC, the same regulator that monitors large futures exchanges like the CME, the Chicago Mercantile Exchange, or ICE, the Intercontinental Exchange, who owns the New York Stock Exchange. There are binary option providers that you can reach on the internet. They are not regulated by the CFTC. And in that regard, I would say if you ever had a challenge, a problem, if something nefarious was going on, and you wanted some type of recourse, good luck. They're just an offshore exchange, and your recourse might be pretty limited. And there's some nefarious actors out there, people who do things that aren't totally on the up and up. And people, if you look out on the internet and Google it, someone will tell you that Nadex is one of them. That's simply not the case. We are audited, regulated. We have to adhere to the laws, rules, regulations of the United States, and we report into the CFTC. There is, if you want your money out of your account, you can get your money out of your account. Sometimes that can't happen on some of those, or people have challenges with the offshore exchanges. So enough about that. But what was Nadex built for? It was built for the retail trader. And what does that mean? We've got contracts that have a very low cost to entry, low notional value. You do not need thousands of dollars to trade at Nadex. You could do it with hundreds of dollars. Of course, you can trade with more money, and you could scale your size up and down if you'd like. But if you're just a small trader just learning how to trade, it's got a low cost of entry, and every one of our contracts has defined risk. You know exactly what you're getting into before you place a trade, so you can never lose more than what you initially put into a trade. Unlike other futures exchanges where you put up good faith margin, you can get margin calls, you can lose more than your entire account. That can't happen in Nadex. Small contracts, very defined risk. And we've got contract binary options, call spreads, and knockouts. But what's really interesting is it's short-term price action. People looking for that short-term price action. And often the people that come to trade at Nadex are specifically looking at technical analysis or using technical analysis to access that price action. And that's sort of a long-winded way to get to, let's talk about the basics of technical analysis. Now, by the way, I want to mention, if you're new to Nadex, I like to put this up front because sometimes I forget, and you're not taking advantage of this, we do have a refer a friend program. You've got a link. If you look at the bottom of that slide, you'll actually, there it is. You see it says copy. You have a personal link if you have a live account. And you can invite your friends. If your friends sign up using that link, if they place 5 trades within 30 days of signing up for their account, you both get a bonus. We'll give you each $100. So they get $100, you get $100. You could do that with up to 10 of your friends, and you could end up getting $1,000 into your account. And I know a lot of people and their friends, they trade together. They help support each other. So something that if you weren't aware, we've got that program. So let's get into technical analysis. And first, a brief history lesson. Where does technical analysis come from? So this is kind of cool, I think. You might have heard this name before, Charles Dow. If you haven't heard Charles Dow, you might be familiar with some of the things that he did. First, in 1882, Charles Dow founded a company called Dow Jones. He did it with a colleague of his, Edward Jones, and they created a company, Dow Jones and Company. Now, that might sound familiar because they built the Dow Jones Industrial Index. Actually, I think that's my next point. In '89, Charles Dow had a newsletter. He had a newsletter. It was an independent newsletter at the time. Back in the late 1800s, a lot of the media, they were paid to do news. And so they were often promoting whatever they were getting paid to promote. They created an independent newsletter in the financial services industry to be independent and just provide financial news. That eventually became the Wall Street Journal. So when it comes to Charles Dow, those are a couple of really cool things: Dow Jones Company and the Wall Street Journal. Now, he did calculate with Edward Jones. Edward Jones was a statistician back then, and they calculated an index, an average, the Dow Jones Industrial Average. We still look at this to this day in 1896. All right, now that is actually really important because the concept of trying to put a number, a metric on the broader market, there was a reason why Charles Dow wanted that. And he calculated this number with Edward Jones, and he had a theory. It's called Dow theory. If you take classes, you might take a class on Dow theory. And Charles Dow had some ideas, and he had some principles, some theories for understanding and analyzing market behavior. He wanted to be able to take a look at what was going on in the markets and strange. Okay, he wanted to take a look at what was going on in the markets, and then that concept, that the theory, the Dow theory, the principles for understanding and analyzing market behavior became the foundation for technical analysis. Charles Dow is thought of as the father of technical analysis. Now, what is the theory professed? All right, what is the concept that Dow was putting forth? And Dow put forth this concept that markets are efficient. All right, and what does that mean? There is news. All right, so companies put out their financial reports. They put out their balance sheet, their income statement, their cash flow statement. You know, everyone can see what the the performance of the financials of companies are. News that might impact a company, whether it's new legislation or something happens in the markets. All of that, according to Dow, is incorporated in the markets, and the markets are very efficient, and they price that immediately into the price of assets. All right, whether it's the price of a stock, whether it's the price of a commodity, whatever it is, that the markets get all of the news, that the markets are efficient, and that everything is discounted into the price of the asset at that moment in time. So if everything is efficient at the moment in time and you've got a fair price in the market, well, then you can put that price on a chart. You could put a dot on a chart, all right, and say, at this time, this was the price of an asset. And then you can plot the price movement, whether the price of an asset's going up or going down, and that there would be patterns that you would tend to see, right? That you would start to see patterns in the chart that would be identifiable. And what is it that would cause those patterns? Well, if the markets are totally efficient and all news is immediately discounted, prices would they would trend based on supply and demand. That when there are more buyers than sellers, the price would go up. When there's more sellers than buyers, the price would go down. And that the only thing, and you would get trends, okay, more buyers, more buyers, more buyers. And then the only thing that would shift a trend would be a shift in supply and demand. When, all right, you've exhausted all the buyers and now we've got more sellers, the price would come down. So you would get these price movements in an asset, and they would trend, and then they would trend based on supply and demand, and that you would see repeatable patterns. And if you could see these patterns and identify these patterns, then you might be able to do some analysis on where you think the price of an asset might go. So this is why traders care about technical analysis. If you've got a chart and it's based on supply and demand and markets are efficient, and you can look at these patterns on a chart, you could take advantage of reading charts and price patterns. And what would you be looking for? One, you would be looking for those trends. All right. Is it in an uptrend? Is it in a downtrend? Where are there going to be reversals? Oh, look, the trend was going down. There were more sellers than buyers. When might we see a reversal in that trend? When buyers would come in and start pushing the price back up. In the financial services industry, we've got a clever little saying, the trend is your friend. You've probably heard that before. It's a nice little rhyming saying that when you see a trend, go ahead and get on board, ride the trend. And when the trend reverses, get off and go the other way. So this is what traders are doing. This is why traders care about technical analysis. Traders are using changes in price to identify opportunities in the market, right? And what opportunities are you looking for? You're looking for entry points. Hey, when might I want to be a buyer? When might I want to be a seller? And in Nadex markets, you can sell first. You don't have to always start with the buy. I can think the price of something is going lower and sell it and buy it back at a lower price because you're just trading price at Nadex. And everything is limited risk. So you can identify entry points and also exit points. All right, so you would do those exit points, and the exit points there's two types of exit points, right? You've got profit levels. Hey, I got in. This is great. Where might I look to be getting out? When you get into a trade, you should have an idea of where you might want to get out for a profit. But then you also might want to have, oops, I didn't read the chart right, or something else happened, or whatever it is, the trend, it didn't do what you thought it was going to do. You might want to have a stop loss to say, okay, this is what I was seeing. I entered a trade. I was looking for this. I was wrong. Okay, get out. Here's my stop loss level. So traders care about technical analysis. They look at the chart. They look for opportunities on where they might want to get in, where they might want to get out, either as a stop loss or a profit target. And there's some good questions coming in, and I will answer them when we get over to the Nadex platform. But this is why you care about technical analysis on the markets. Okay, now let's start talking about the basics of technical analysis. The first off is a chart itself. Okay, we're going to look at a candlestick to begin with. All right, now if you notice, we've got two types of candlesticks. We've got a green one and we've got a red one. All right, now when you look at a candlestick, you'll notice that there is there's a body. All right, there's a body, and then there are these lines that come out of it, which we call wicks. Okay, now let's talk about the body first. The body has got, the reason they give you a body is there's a top of the body and there's a bottom of the body. If the candlestick is green, if it's green, the bottom of the body is where it opened. Okay, and we're going to talk about time frames in a bit, but let's just say, for example, we're using 15-minute candlesticks for argument's sake. This is a 15-minute candlestick. This means in this 15-minute window, if it's green, the bottom is where it opened during those 15 minutes. The top is where it closed in those 15 minutes. Now, it's the exact opposite if you've got a red candlestick. If you've got a red candlestick, it means it closed lower than it opened. So the top of the candlestick is where it opened, and the bottom of the body is where it closed. So that is the body. It is the open and the close for this 15-minute candlestick. This candlestick is a snippet in time, and you can have candlesticks that are 1 minute in length, 5 minutes in length, 10 minutes, 15, 30 minutes, an hour, daily, weekly. You choose the time frame of an individual candlestick. So again, we're going with the 15-minute candlestick. Now it's got these wicks that come out above and below, and that just gives you the high and low of the range of that 15 minutes. Now, so if I look at this green candlestick, I get a lot of information in this one little picture. In this one little picture, I know exactly in this 15-minute window where it opened, where it closed higher than where it opened. I know it had a high higher than where it closed, and I know it had a low down here. Now, does a candlestick have to have wicks? And the answer is no. If it opens and at the lowest price during that 15 minutes, and it closes at the highest price during that 15 minutes, you'll have a green candlestick and there'll be no wick at all. Now, this wick could be nothing. It could be very, very short. It could also be really, really long. You just don't know. It could be anything. And when we look at the chart, you'll understand. But in every candlestick, you've got some great data right there. Where did it open? Where did it close? Did it close lower? Did it close higher? And what was the high range during that period? And what was the low of the range during that period? That is the anatomy of a candlestick. Now you get one candlestick, and that's great. And let's again just say 15-minute candlestick. When I look at a chart and I put in 15-minute candlesticks, it's going to give me one candlestick for every 15-minute period. Now, what happens after this 15-minute period? I get a second candlestick. And after that 15-minute period, I get a third candlestick. And when you look at a chart, you're looking at a bunch of candlesticks placed next to each other. All right, and you can look at whatever time frame you want. You can look in the last 3 days. You can look at the last year if you wanted to get crazy, and you can look. So your chart itself can be whatever time frame you want to be looking at to do your analysis, but you also have the time period of an individual candlestick. All right, and you've got to choose, what period of time do I want for my candlestick? So let's talk about, I said you put these candlesticks together and you'll end up with a chart and you'll end up with trends. And I teed this up with trends and time frames. Let's take a look at some of this. So first, when we put these together and we're looking for trends, the question is, and this is important for time frames, which time frame do you want to be using? And so let's take a look at a little trend. All right, here's an image of a trend. Okay, it doesn't matter what the 15-minute, 1 hour candles, whatever it is. I'm looking at a chart of something, and you can see that it's clearly in a downward trend. But your time frame does matter. It's like if I say it doesn't matter, you're gonna go, yes, it does, because if I look at this time frame, if I'm looking at 1 minute candles, this tells me what's happened over then. Let's say there's I don't know, 1, 2, 3, 4. Let's say there's 40 candlesticks in here. This might be a 40-minute time period. Okay, in the last 40 minutes, it's been in a downtrend. But let's take a step back. If you take a look at this chart, this is actually this chart right here. I just took the end of the chart. At the end of the chart, yes, it's a downtrend. But if I took a step back, it's actually part of a longer term uptrend. So your time frame does matter. What are you looking at? Are you looking at something much longer term? And is it part of a longer term trend? Or am I looking at something very close, very short term? And it's not just the period of my chart. As I mentioned, it's also going to be the date range for the chart, but the time interval for each candlestick. So you're going to have to make those determinations. Do I want to look at 1 minute candlesticks and look at the last 3 hours? Do I want to look at 15-minute candlesticks and look at the last 3 days? I could still use 15-minute candlesticks and look at the last 3 hours, but I have to realize that each candlestick's 15 minutes, and that might give me one view, one picture. But if I drop my time frame or I expand my time frame of the candles, it might give me a different picture. So when you're identifying trends, the time frame of what you're looking at is relevant, and you've got to make a determination. How do you want to look at the markets? And it's both the time interval for each candlestick, which is pick one spot in time, and then the date range, the time range on the chart. How far back do I want to go? If I zoom in close, it might be a downtrend. If I zoom further away, it might just be part of a larger uptrend. Maybe that helps you determine when a trend is going to change. So, which actually brings us, so this is trends and time frames. And the question then is, as I just mentioned, if you're looking at it from a longer term, you take a little step back, it might help you when a trend might change. And that's actually called a reversal. All right, so let's talk about reversal patterns. I am going to give you 2 reversal patterns. There are a bunch of them out there. If you go on Google and you put in reversal technical analysis patterns, you can find a variety of them. I want to show you a couple of the basic ones, and this is how people tend to look at charts. The first one I'm going to show you is called the hammer. Okay, and here's a picture of the hammer. Let's go through what a hammer is. Oh, you know what? Before I step there, so let's just first take a look. It looks like a hammer. Okay, this is the image of a single candlestick here on the left. All right, it looks like a hammer. It's got a body up top. Oop, it's got a body up top. And it's a smaller body, and it's got a long wick below. That's that green one. And so it looks like a hammer, right? It looks like a mallet. Now, a hammer can also be red. It doesn't just have to be green, but a green hammer is a stronger indicator than a red hammer. A green hammer, it just shows the top of the hammer, the body, and notice there's no wick up above, is that the close is higher than the open. So it opened and it closed higher, but it did have this large spike down. Now, it can open and have a large spike down, and it can close below the open. It is still a hammer. Now, where do we look for a hammer? Oops, sorry. Where do we look for a hammer? Now, if you're looking at the chart on the right-hand side now, and the hammer is a buy signal, okay? The hammer is a buy signal. And where do you look for a hammer? You're having a downtrend. So something is in a downtrend. It's going down, it's going down, it's going down, and then you get this hammer candlestick. Now, what is that hammer candlestick showing you? It's showing you that the sellers have hammered it down, but they have become exhausted. They've gotten tired. When you get a hammer with that long wick below, that means the sellers came in, sold. They tried to sell it all the way down, and buyers stepped in, and that's why you've got that wick, and that's why you have that little body up top. All right. And that means they tried to push it down, and that's as far as they can go, and it came back up. And if you're in a downtrend and you see a hammer, sometimes that indicates a reversal, and you would start to see the price going up. All right. This is a pattern that traders look at for a reversal. So when you've got a trend, hey, get on board, you got the trend. But if you're riding a trend and all of a sudden you see one of these show up, you might want to go, this trend might be changing. We might be seeing a reversal. Now, another reversal pattern, it's called the hanging man, and it actually looks a whole lot like a hammer. In fact, I didn't have to make the pictures look that, they could have looked the same. They're going to look very similar. In this particular image, it's just showing the body being a little bit smaller. But the difference between a hammer and a hanging man is what type of pattern you're currently in. In a hanging man, you look for it, you're in an uptrend. You're in an uptrend, you're in an uptrend, you're in an uptrend, then you get a hanging man, and all of a sudden you might see that. You might see that as a potential reversal. The hanging man would be a sell signal. All right, so the hammer, if you're in a downtrend and you see a hammer, it might be a reversal where it's going up and it's a buy signal. If you see a hanging man, you're in an uptrend and you see a hanging man, it might be a sell signal. The stronger ones, when it's a buy signal in a downtrend, if it's green, it's a little bit stronger. If it's a red one in an uptrend, the hanging man, the red one's a little bit of a stronger signal. And that's really what I wanted to get here for the reversals. All right, you've got the hammer is a buy signal when you're in a downtrend, and the hanging man is a sell signal when you're in an uptrend. All right. And again, if you would like these slide decks, I'm going to put that plug out there. Email customerservice@nadex.com. They can get you the slide decks. Now, we've talked about trends. We've talked about reversals. All right. You got a trend that's going, and then the trend goes until it doesn't, and it reverses. Now, let's talk about support and resistance. Okay. Now, support and resistance, a lot of times support and resistance is really based on supply and demand. This really goes back to what Charles Dow was really looking for when he was trying to identify opportunities in the market. I've got a chart here of the S&P 500, and I drew on here some places where they're important. They're important times in the market. You can actually kind of see where there are levels that are kind of important, and they become levels of support and resistance. Sometimes because there's so many people looking at these charts, they become a little bit of a self-fulfilling prophecy. When I see at the bottom, I've got a place where, and that's over on the left, that yellow arrow, where there was support. When it would come down to this level, buyers would tend to come in and support it. It was difficult for it to go any lower. Then there's this level up above, all right, that was initially resistance. All right, it when it got up here, sellers showed up, but eventually it pushed through. And then when that broke, it came all the way back down to our support line below. That support line, notice how now it was a support line early in the chart. The market rallied. When the market fell, it acted as support again. All right, so this is why these are those patterns where you're trying to go, wow, it reversed, it was going down, it might see support back where it was seeing support before. And then resistance up at the level above. And notice, at this part in the chart, it punched up, it touched it once. It punched up, it touched it a second time. It even tried a third time, but it continued to act as resistance. And when it pushed down lower, it found support again. I mean, you can see how this is the third time it's come down to this level and it's found support. Now, can I have support and resistance in between? I mean, could I have looked at levels in between? And sure, there's levels in between. One tool, and we've got this on Nadex, that some traders like to do to help them identify support and resistance is called Fibonacci. Now, if you've never heard of Fibonacci, it's Fibonacci retracement. Fibonacci is a mathematical sequence. You don't need to know the mathematical sequence, although it's an interesting one. I think if you read the Da Vinci Code, they used the Fibonacci sequence in part of the mystery solving that they had. But the Fibonacci sequence is a ratio. It is a naturally occurring ratio. It's something that you see in nature. That ratio, you see it in seashells, you see it in flowers. Interestingly enough, it's a ratio that you see in the human body. It's such an important ratio that a lot of our architecture is built around this ratio. The math is done for you, and I will show you how to do a Fibonacci retracement. But in this particular instance, I drew a Fibonacci on here, and this is after the fact. I drew a Fibonacci on here, and you can actually see that two of the levels, yes, this is the top end of where this chart was. Here's the bottom end of where the chart was. And you can actually see this level right here, this one that we had drawn in that was the resistance, that is actually the 76.4 retracement level on the Fibonacci. It was an important level. Now, what's interesting is there's all these levels in between. And were they important levels? And yeah, they actually kind of were. If you look at these down here, the 23.6 and the 38.2, you can see that those acted as support and resistance levels. Later in the chart, it was support, and there were places where it was definitely resistance. Now, did it stay between these two numbers? No, it actually moved outside. But when it moved, right? Oh, by the way, I mean, yeah, when it moved outside, notice that the retracement levels around it were resistance up above and support down below. So you can each of these Fibonacci levels, oops, I'm going to go back to that chart. Each of these levels acted at some point in time as some support and resistance. And depending upon the time frame of your chart and the time frame of your candlesticks, it could help you identify potential opportunities where you might want to look to buy, where you might want to look to sell, or where you might want to, take profits or limit losses. So we've gone through, let's just do a quick little recap. Trends. You have uptrends, you have downtrends. The trends go until they change, which is called a reversal. When you see a reversal, it's going to start trending the other way, and that's a trend the other direction, often called retracements. And beyond just trends, we tend to see, traders also look for support and resistance. Often a lot of that is based on supply and demand, but there are some tools out there like Fibonacci, and there are other tools, and we'll take a quick peek at them, that can help you identify potential interesting levels for trades, whether it's entering a trade or exiting the trade. All right, now, I mentioned all these tools on the Nadex platform. We've got, and I'm going to go through 1, 2, 4, I should know this number off the top of my head, 6, 8, 10, 12, 14, 16. We got about 26, 20, something like around 25 different indicators. All right. These are all indicators. If you're not sure what these indicators mean, we have in-platform education, a little I, that gives you an idea. All right. You don't know what MACD is. Well, I can hover on the I and it tells me it's a moving average convergence divergence. It's moving averages either coming together, crossing, or going apart. But it's people look for when moving averages change, when one moving average a certain period, when you get a cross, you might be looking for, either a sell signal or a buy signal, depending upon what time frames you're looking at and what's happening when those moving averages change. But we've got a variety of technical indicators, Bollinger Bands, relative strength index. You can choose other moving averages, not just looking at the moving average convergence divergence. There's a variety of average true range, kind of gives you what you might expect to see for the range in a particular day. How much volatility might you see, or what kind of move might you see in a particular asset for that day? So some great indicator tools all available to you. You don't need to know how they're calculated, but what you would want to do is you'd want to understand how to use them. What is it that they mean? And there's plenty of information out there. I would say go to dailyfx.com, tons of education, and you can learn. Dailyfx.com, tons of education on technical indicators. We've also got drawing tools, and so that you can put your own drawing tools on there. Fibonacci retracement is a drawing tool. People traders often put in their own support and resistance lines or their own channels. A trend, and I will actually show you this when we go to the platform. A trend in an uptrend, it might be in a channel where even while it's trending up, you can see support and resistance in an uptrend or a downtrend that can help you identify potential opportunities. So you can put just a plain trend line on there. I'm going to play around with these tools shortly. I just want you to know that we've got a lot of it available to you on the Nadex platform. All right, big last slide, and I save it for the end, but I probably should put this all the way up front. And this is really, really, really important. So hopefully I've got your attention. I always like to have one really important rule, one big takeaway from any of the sessions that I do, because I think it's something that you need to be aware of. And this is caveat emptor, buyer beware. When you are using technical analysis, be aware. All right. There is another saying. We have the trend is your friend. Another one, even the Titanic had a chart room. In fact, you might even hear it another way. Every ship at the bottom of the ocean had a chart room, all right? And they still sank. Charts are not 100% accurate. This is what's going to happen. You can look at a chart, you can read a chart, you can make some assumptions, you can expect or you can hope that something happens a certain way, but it does not have to happen that way. You've got to manage your risk. Always manage your risk. Even though you're looking at a chart, it doesn't mean that is what is definitely going to happen. It is a tool. It is a tool to help you. It is not the definitive answer. So having the ability to read a chart, understand a chart, look at trends, look at reversals, look at support and resistance, very, very helpful. But it doesn't mean that is what's going to happen. You've got to be a little bit careful. And again, every ship, the Titanic had a chart room. They had a wonderful chart room, and they might have even been reading the charts exactly the way they wanted to read them, but it still hit an iceberg and it sank. So you do have to be a little bit careful. I don't want you to think, hey, I got technical analysis. Look at this. I'm using this technical analysis tool. How could I go wrong? No, you've got to manage your risk. You've got to manage your risk. Okay, with that, I am now going to jump over and do a little bit of off-roading on the Nadex platform. Again, remember, not a buy or sell recommendation. We're just going to play around with the charts a little bit. And I am going to answer the one question regarding stop loss on trades. I will answer that one, so give me a second here. I am going to switch screens. And again, if you would like this slide deck, please email customerservice@nadex.com. And you got to tell them which slide deck you're looking for. Okay, here is the Nadex platform. Now, I am not going to be doing a platform session going through all the tools. We've got full-blown sessions. I believe we're actually doing one next week. My colleague Adam McCaden is going to be doing it. If you haven't registered for it yet, by all means, please register. You can find it on the Nadex YouTube channel. Oh, by the way, that reminds me of one other thing. If you're new, we are going to be having a boot camp, how to day trade FX markets. And you know what? I'm going to drop in a link. If I think I can do this right. Let's see if I can do this right. I am going to send this to everyone. I just dropped a link out there. I wonder if you guys all get it. If you can't see it, I should be able. I was trying to figure out how to do this over on the dashboard. We're having a boot camp on June 22nd. How to day trade FX markets. It's free to register. If you register for it, you'll get the recordings will be made available to you, as well as the slide decks. So go register. Tell your friends. Have everyone. June 22nd. It's a free virtual education day. It's going to be 5 hours long. Register for it. How to day trade FX. Excellent. So yeah, go take a look and have your friends register. And you will get access. If you can't join that day, if you register, you will get access to the recordings, and you will have the ability to request the slide decks. So I wanted to put that out there. All right, let's take a look at a chart now. This is a chart of gold. I brought this up today just because this morning, if you missed it, the inflation numbers came in this morning in the U.S. Inflation number 5% year over year. Last month, it was 4.2%. We are definitely seeing inflation. Well, if you're seeing inflation, the price of things is going to go up. Yeah, gold jumped. Gold jumped from 1875 all the way, we're getting close to that 1900 level, which, by the way, is a resistance level, and it's also a psychological level. Now, let's play around with some of the tools that are available. First, notice the first thing I'm going to show you is this is a 15-minute chart, okay? I could make this a 1-minute chart, all right? And, I've got a slightly different view of what's going on because I'm seeing it every single minute. I could make this an hourly chart, all right? And, you're going to see these movements, but you've got to make a determination. Do I want to see well, we don't even have that, you've got to make a determination how big you want each one of your candlesticks. I think a lot of traders will often will use 30-minute charts. Sometimes if they're going to look back a little bit, they're looking for broader trends, particularly in Nadex. I like the 15-minute charts. It's the ones that I tend to use myself, but everyone's got to make a determination what they want to look at. But then not only do you have each candlestick, so here each candlestick is 15 minutes. So I know that gold jumped from roughly 1875 up to 1894. If these are 15, it did it in 30 minutes. Here's a 15-minute candle. Here's a 15-minute candle. That was an interesting 30 minutes in the markets. So it helps. All right, it gives me an idea of what's going on. I'm actually going to, you can see I've still got drawings on here that I've done from a couple weeks back when I was just looking at support and resistance levels. What's really interesting is how close these are. When I was looking back here in time, if I had extended it, it's essentially that level actually was one all the way over here as well. So when you're doing your analysis, it's kind of interesting how these patterns. God, that is really interesting. I'm just going to draw. I didn't even look at it. If I had extended this out, it's almost the exact same. You can see I hadn't even done that before. It's interesting how these levels for support or resistance tend to repeat themselves. That's what people are looking for. All right, not only do I have my chart, I can choose the calendar range. Well, what I would like to talk about are some of these, or just show you how to use, are some of these indicators. So I mentioned, we wanted to look at average true range. You drop it on. Now, it gives me how much I might expect to see gold move in a day. And you can see the volatility in gold's been pretty high. The average true range has been swinging around because, and the reason that is, and you don't have to make it that big. Notice I'm shrinking it down. A lot of people just want to know what the, just get an idea of where we are in the average true range. Inflation's been the number. Gold has been a volatile hot spot in the markets. There's been trading opportunity in gold. So yeah, the average true range has been bouncing all over the place because we've had so much volatility in gold. Relative strength index, another one to help you when is it overbought and when is it oversold. And you can see, look, I mean, it actually told you, hey, it's oversold in here. This is a buying opportunity, and that corresponds to this buying opportunity in the charts. It got very oversold, and some people might have gotten washed out in this little move here. But it also gives you places where when it's in the red, when it's overbought, it's in the red, so it becomes a sell indicator. When it's oversold, it's in the green, it becomes a buying indicator. People use relative strength to help them, identify potential buying and selling opportunities as well. So there are a bunch of these indicators all listed down the left. I also want to talk a little bit about the drawing tools. I did show Fibonacci. Let's do this. I'm going to, let's just move to a 10-minute chart. Oh, no, I still got, let's go to a 30-minute chart. Maybe that'll take that. There we go. Okay. And I'm going to get rid of these indicators. Let's just turn these off for a second because I want more room on the chart. Okay, because I want to show you how Fibonacci works and how you would draw a Fibonacci. Here we go. It's under my drawing tools. Here's a Fibonacci retracement. And the way you do a Fibonacci retracement, and I could do this one of two different ways. All right, I'm going to do it this way first. Notice up on the left-hand side of my chart, it's higher than where it was, down here. Here's the low end of the chart. Let's actually start up here. We click once. We go down to the low. We click twice, and then we drag it over. And we've got some Fibonacci retracement levels. And now you're looking at these different levels, and were they levels of support and resistance mathematically? Yeah, I mean, it really is kind of interesting. I'm going to draw just where, in this, how you would see that. I mean, this level right here was clearly a consolidation area, the 23.6 Fibonacci. And it acted as, it first acted as resistance, but then it became a support level. And in fact, it's a support level all the way back here. When they had this washout, it was very close to this level down here, and you might have thought, hey, this is a buying opportunity, and you would have been right. All right. Let's just take a look at some of these other, I'm just grabbing a rectangle, and the 50% Fibonacci retracement level was important right in here. You can see it acted as support. Right? It was coming down. It acted as support. It bounced off of it. It came down. It was support again right here. All right. Then it was support here as well. Now, what's interesting, when it broke through this level, it then becomes resistance. Notice that it actually came down, oddly enough, to the Fibonacci level right below. And when it went back up, it was resistance, and it went lower. And it came all the way down to this Fibonacci level where it acted as support again and took off. So can you use Fibonacci? Yeah, I just showed you how to draw it. If we were in an uptrend, so I'd have to grab a different chart. Let's just see what we've got. I think oil might give us an uptrend chart. Let's take a quick peek. Wow, okay. Oil jumping all over the place, and I'm going to drop this down to a 15-minute chart. And here, I'm just going to show you how to do Fibonacci the other way around. is I go to my drawing tools, I grab Fibonacci retracement. Here I'm going to start at the bottom of the chart because we were low. I click once, I went up to the top of the chart where we're at our highs, clicked a second time, and then I just drag it over a third time. So you can either go, you start on the left and you work to your right. If it's in a downtrend, you go on the left, the top to the bottom and over. If it's an uptrend, you go from the bottom to the top and then over. And you can see, yes, this was a support level right here. It bounced off of it. You can see this Fibonacci was a resistance for a bit of time until it punched through. It became a support at this level. And then I'm not sure what just happened with at noon. Something happened at noon because I could see right at noon there was, oil spiked lower. Wow. And it's immediately coming back. I was on this webinar, so yeah, we can go back and find out what happened in the last hour. Oil made a very dramatic move right at noon. In regards to some of these other drawing tools, I'm just going to show you. Here's a simple trend line. I said I wanted to show you a trend line. Here's a simple trend line. I click it once and you kind of put the trend line on, and I can say, okay, I'm kind of looking at this trend line, but does that help me? What a lot of people will do instead is, let's go back. I'm going to go back to gold just because this crude oil chart is all over the place. Volatility galore. All right, so here's the gold chart. All right, and I want to show you. We were clearly in a downtrend. We've reversed. All right, we were in a downtrend, but let's just take a look at that downtrend for a second. I'm going to do a channel. I'm going to do the top end of the channel, and we were in a downtrend. And then I'm going to do the bottom end of the channel. Now I can move that around a bit if I wanted to, but you could see now this is a trend, but it's a wider trend. When you were going lower, it kept on getting lower lows, lower lows, lower lows, and it was also getting lower highs. All right, we started up here. The high here was a lower high, a lower high, a lower high, and it punched through the channel, but we kept on getting lower highs and lower lows. We're in a downtrend. Uptrend would be the exact opposite, but it might help you identify, and you can play around with these trend lines and your channels so that it can help you make some decisions on when you might want to potentially be a buyer and when you might potentially want to be a seller. And you can use different technical analysis tools. Right here, for instance, this was hitting the top end of my trend, my channel lower. And I also had my support and resistance line on here. You can be looking at different things and say, that's a confirmation. I definitely want to be a seller. And you could have potentially taken advantage of this spike down. And in fact, when you took advantage and it spiked down and hit the bottom of the channel, that's when you would have exited your trade. Even if it kept going lower, that would have been telling you, hey, I saw it was a sell signal, I sold it. It came down here. This was my expectation for a profit. I bought it back. And it bounced off that, and eventually it went lower. But again, you're looking for short-term opportunities. All right, we are coming up at the top of the hour. Hopefully you found this useful in both how to use some of these indicators, how you could potentially put some of your own drawing tools on here, and understanding the basics of how to look at and read a candlestick chart. The time frame for each one of these candles, the time frame for your entire chart, how you're looking for trends, how you're looking for reversals, and how you're looking for support and resistance where it's more buyers, where buyers might show up or where sellers might show up. With that, I want to thank you for joining us today. I want to, you know what? There was a question that came in. An ATR. What is the? So let's just go back to ATR. I want to answer this one very, very quickly. I am going to go back. Helps me if I can click on these. ATR. All right. So what is it telling me? All right. It's telling me the range that you might. It's an indicator of high or low volatility. When the average true range, this is how much you might expect it to move. And that's not pips. I mean, this is, and it's telling you, is it going? Could it potentially be making a very large move? Yeah, we're in a high volatile environment. So it's really a measure of volatility. It's really a measure of volatility, and making a determination, how much you might, the range you might expect to see. Am I expecting to see a large range or a shorter range? All right, with that, I want to thank everyone for joining me today. I want to be cognizant of everyone's time. Again, this was recorded. Again, you can request the slide deck from customer service at nadex.com. Please join us for the boot camp in just over a week and a half, Tuesday, June 22nd. And join us in the mornings when we break down and do some technical analysis. Go to YouTube. We live stream every morning, 8:45 a.m. Eastern, 7:45 a.m. Central. We live stream. The recordings are made available, but you can join us, and you can always type in and maybe get some questions answered there as well. With that, thank you for joining, and I want to wish everyone good luck in the markets.